I want to tell you why the median sales price of a home, as reported by the Association of Realtors, is just a big fat lie. Now, is it factually true? Yes. And that's where they get you. The Association of Realtors has been one of the biggest, both locally and nationally and regionally, one of the biggest misinformation machines, propaganda machines about real estate that we've seen in 100 years. So the Association of Realtors and the largest real estate companies do what? They try to speak into existence the best data they can based on the market that causes exactly that to happen. I mean, nothing wrong with that, right? Except, wait a minute, right before the biggest crash in real estate history, the chief economist, no longer there, at the National Association of Realtors says this is just a speed bump in housing. That was circa 2007, 2008. And then the wheels came off. So the question here is, what's the truth? And here's what the Charleston Trident Association of Realtors says based on their own MLS data, which is factually correct, but disingenuous. The 2026 regional median sales price rose to $460,000 in the Charleston Tri-County market, making a 7% year-over-year increase and a new statistical high. Tight inventory of 3.4 months continues to drive this steady price appreciation. There's nothing factually incorrect about that. There's nothing wrong with that number. But here's the problem with the median sales price. It doesn't compare anything because it's really a component of buyer behavior. That means half the homes that sold were under that price and half the homes that sold were over that price. That doesn't mean that the home that you bought last year in Cane Bay and Somerville, or in Seaside Farms in Mount Pleasant, or in Avondale and West Ashley, if you put it on the market this year, the exact same home that you paid, I'm just going to pick a random number, $1 million for, that you could sell it today for $1 million. In fact, it's quite the opposite. The truth that's not revealed in any of the data they put out is that that home, if you compared it to a year ago or 2 years ago to today, would almost certainly sell for 3 to 8% less than it did then. So, well, what proof do I have of that? Well, I don't have statistical proof because you don't see year over year the same houses selling again. This isn't like the stock market. We don't, that's what realtors do. They pile up, the Realtors Association, they pile up all the data and say, well, the data this year is higher than the data last year, as if though to measure the Dow Jones at the open today is up 140 points when it closed. Well, but we're comparing the exact same stocks with the exact same time frame, so like if you're comparing General Electric, it's like comparing General Electric is the same house. It has the same features, the same components, the same everything. Virtually no upgrades have happened. It's just been maintained. Well, we don't have the ability to do that in the housing business. So I've always thought the average sales price was a better barometer of what's actually happening in the market. But even that is subject to human behavior. So let me run through some national stats. And then let me give you some regional specific canaries in the coal mine that I've been watching that I think are very concerning about where we may be headed as a housing market in Charleston. Nationally, the median asking price of all homes fell 0.4% year over year. New listings are actually being priced at 1.2% higher. So we have two things going on there. We have the actual national numbers showing a little bit of distress. Foreclosure numbers are up quite substantially. And we have people still listing their homes acting like they're listening to the realtors. So that's where I have a problem with the disingenuous nature of the Association of Realtors as they put out the data, because they provide no real context. They don't say, well, 3.4 months of inventory is still strong. Yeah, that's not bad. But 2 years ago, it was a month. So we are on an accelerated campaign of having more and more houses sit on the market unsold because people are pricing them too high, and the national numbers vet that out. Austin, Texas is a good example of what I think is coming for the rest of the country. Nashville, Tennessee is seeing a little bit of this too. And I think these markets are interesting because they've had a similar attractiveness to Charleston, a burgeoning market, attractive for their politics and their opportunity and small business and entrepreneurship and such as that. And they created this huge influx of demand and price increases, much as did Charleston during the COVID era, 2020 to 2023. And Austin, Texas is down 25% over the last year and a half in home values. It's a real mess over there. There are parts of South Florida that are way down. The condo market in the high-rise segment of the coastal condo market, just like what we saw with Dockside here and Surfside in Miami, the collapse, Dockside being condemned here. There are some number in Florida, I think it was 376. Don't hold me to that, but I think there's 376 high-rise condominium complexes in the state of Florida that are deemed unsafe. 20-odd of them have been condemned, evacuated, or other similar actions. Those are anecdotal numbers, but they're accurately a good reflection of what's happening in a bad way. So we're seeing older houses that need renovation, more traditional offerings lagging on the market, taking a long time to sell. The more modernized, more updated, well-priced stuff is selling as if though the market's still really strong, because underlying this particular era of decline in housing, let's call it what it is, decline, we're seeing still some demand at the basic level. Like if you've got a house that's fairly modernized, like in Carolina Park, Dunes West, Rivertown Park West, in North Mount Pleasant in the 1 to 2 million range, or in that 1.5 to 3 million range in South Mount Pleasant, highly updated, there is an amazing amount of demand for that. Where I'm seeing some of the weakness is in the bread and butter of the market. Mount Pleasant under $1 million is not as strong as it was. Townhomes and condos in Mount Pleasant are sitting and lagging on the market at prices that are $40,000 and $50,000 less than what they were getting multiple offers on a year or two ago. I mean, there are townhomes in Dunes West that would have easily brought $700,000 in 2024, even to 2025, that are now on the market for $650,000. Same exact townhomes unsold. So these are the stories that aren't being told. Are prices falling? The answer is yes. The median sales price reflects the behavior of what people can afford. It doesn't reflect the fact that homes are being sold for a lower percentage of sales price to list price, that sellers are reducing price no matter if they're listing higher than they should be. They're having to reduce price to get them sold, and interest rates are going up, giving buyers pause. So when you look at the numbers, I want to caution folks. I said this in an earlier video. If you look at what is happening on Wall Street, it's a more visible, spotlighted version of what's happening in the real estate market. It's unaffordable. NASDAQ's trading 33 to 35 times earnings, depending on how it's closing. And that's about double where it should be. And the last time that happened, the last two times that happened, the stock market crashed within a few months of such a number. I'm not saying the stock market's going to crash. I'm not saying I'm an expert in stocks. I'm saying that if you look at the valuations of things right now in this country, much of what's out there is uninvestable, including housing. So as I've been saying in other videos, there's opportunity on the horizon. The best thing for you to do as a homeowner or as an investor or someone who is putting their money with other investment trusts related to real estate, I would be getting my money out, parking it on the curb, and not going, oh, it's going to crash, I'm going to run for the hills, but keeping my cash tight so that when the opportunity to make lowball offers comes again, and it's on the way, you'll be in a position to use your cash to make some real wealth from that. You don't need to invest in somebody else's fund that's out buying and flipping and selling houses and you're getting a percentage return on your money. You need to be in ownership. And the opportunity for that's coming in a big way, I think. I don't know how it will happen or under what catalyst it will happen. If it'll be a really bad jobs report that spooks the market, an event that's even greater than what happened in Iran, a combination of factors, we can't know. But what we do know is that there is a needed correction if interest rates don't come down to keep real estate affordable. So older inventory is going to be tougher. And the opportunity is really in the older inventory category. I love to buy the ugliest house in the neighborhood because I can negotiate the most. So if you need help identifying the opportunities as the market transitions, or if you're in the market right now and you need to get your house sold and you've had it on the market lagging with another firm or agent and you're I'm not telling you to cancel your current listing. I'm saying if you need to interview an agent for a future listing of your home, whether marketed now or haven't had it on the market in 3 decades, you need to make sure you've got a strategy that's going to get it sold for the most money and quickly, because if you don't, lagging on the market is going to cost you tens of thousands of dollars in today's market, vetted out by everybody's numbers, even the ones that are disingenuous. My name is Bryan Crabtree. Call me anytime if you just have a random question. No obligation. You won't get hammered by that. You're welcome to ask questions. We give better answers than AI because AI hallucinates. I don't hallucinate when it comes to real estate. 843-343-4141 or online, therealestateexperts.com with Indigo Oak Christie's International Real Estate. Thanks for watching.